Your 30s are a decade of a lot of spending, whether that's buying a home, having some kids, or perhaps just getting married. It seems like you're always being spread thin. And as someone in their 30s right now, I've thought deeply about the financial milestones that we should be hitting in order to be financially sound by the time we're 40. So whether you're in your 20s looking ahead, you're in your 30s like I am today, or perhaps you're in your 40s and you're wondering if I've made all the right decisions, this video is for you. The first financial milestone you want to hit in your 30s before the age of 40 is to have $0 in debt. Now, the one exception here is if you have a mortgage. That means we're aiming for $0 in consumer debt, so ideally you have no credit card debt, as well as the fact that your student loans are paid off. And in my own perfect world, it would be that you do not have a car payment, so ideally your car is paid off, because the average expense for an American these days is closer to $700 a month for a new car. The idea here is that in your 30s, you're in your prime earning years, and so therefore you just really want to ramp up your net worth, and the last thing you want is consumer debt dragging you down. In addition, in your 30s, that's where everything in your personal life is going to start to intersect. You might have more responsibility at work, you might have 1, 2, 3 kids, or even some pets, and you might have to start taking care of your elderly parents. Now, for me personally, when I was in my 20s, I had a really healthy and somewhat young father, and therefore I didn't really have to take too much care of him. However, these days, I find myself spending a lot more time with him because he's just getting a little bit older, he's getting a little slower, just both physically as well as mentally. And sometimes I use my own money to solve certain situations. So for example, I don't know if you guys have parents that are stubborn, but my dad is particularly stubborn and wants to do everything himself. Just last week, we had a sink that was clogged, and this man wanted to go in and just fix it himself, DIY it, if you will, but I knew that that just wasn't gonna happen. So in these situations, I just like to fix it myself, either by doing it myself, by looking it up on YouTube with my time, or I'm just gonna pay a contractor or plumber to come out and fix it for us. And if you still have consumer debt in your 30s, I think this is a perfect time to tackle that, because if I still had a bunch of consumer debt, I probably wouldn't be able to help my parents as much as I can right now. Debt can add layers of complexity into your life, and so I'm always a big proponent of trying to keep your personal burn rate as low as possible. That way it gives you a lot of flexibilities and options down the road. Now, we're still gonna keep our mortgage loan in our 30s because it's unlikely that we can pay that big of a balance off. That's what our 40s and our 50s are going to be for, and that'll probably be in a future video. All right, the next financial goal or milestone that you should hit in your 30s is to have an excellent credit score above an 800. The biggest benefit of having a great credit score in our 30s is going to give us a lower interest rate when we're trying to buy our first home or perhaps refinance that mortgage that we might have. I know that a lower interest rate sounds like a boring benefit, but let me show you guys the math and how big of a difference just a 0.5% interest rate is gonna be. On a loan amount of $400,000 with an excellent credit rating, you might qualify for a loan rate of 6.5%, which is current interest rates, and that amounts to $510,178 in interest over the course of 30 years. If you have slightly worse credit, so not even just like awful credit, just slightly worse credit, you might be able to qualify for a 7% interest rate. That amounts to $558,036 in interest, which is a $48,000 difference over the course of that loan. Now, getting a good credit score is actually not as hard as it sounds. As long as you're paying your payments off on time every billing cycle, it generally tends to go in the upward direction. However, if you do miss one payment and it's more than 30 days late, that can actually tank your credit score. According to LendingTree, quote, a late payment, typically over 30 days, can drop your credit score by as much as 180 points and may stay on your credit report for up to 7 years. So that really re-emphasizes the fact that you should just never have a late payment, because one late payment could drop your score from say 780 to 600, and that's a huge difference. If you're not quite there yet with an 800 credit score, take some time to figure out how credit works. I have a lot of guides on this channel, and if you're already pretty close, sometimes it's just more of a matter of time. The next financial milestone in your 30s is to consider assembling a financial plan for the next 30 years of your life, all the way up until retirement. Now, a good financial plan will tackle a few different categories that are pretty important, and I like to use the acronym BRET. So B stands for budgeting and saving. We should know intimately how much we need to save and spend in order to hit our goals for retirement. The R is for retirement planning. So in addition to knowing what our goals should be, we should also know exactly how far along we are and any other plans that we might need to make in order to retire. The E is for estate planning. I know it sounds a little bit too early to get started with this and what it may look like. However, if you are in your 30s and you already have a kid, this might be a good time to start thinking about it. And the T is for tax planning. Do we have the right strategies in place with our financial plan? So when it comes to this milestone in our acronym of BRET, B-R-E-T, it might make sense to actually hire a financial planner if we decide we need that. The fourth money milestone or goal to accomplish in your 30s is to have a well-stocked emergency fund. In our 20s, we wanted to create a financial foundation for ourselves, and that was done with a 3 to 6 month living expense emergency fund. And I think that goal in our 30s should even be more prioritized than it was before. That's because in your 30s, the more responsibilities that you're gonna have in life is gonna create a lot more pressure on you in general. The kids that you have, the house that you have to maintain, perhaps elderly parents that you might have to take care of, all of these new responsibilities can require some extra cash from you in the form of a liquid emergency fund, especially if things go awry. What happens if your kid needs an emergency surgery, or perhaps your water heater breaks in your house, or perhaps someone just comes to you with a great investment opportunity? It's gonna be really nice to have some liquid cash laying around. Because of this, I think it's even more important to have a well-stocked emergency fund in your 30s, and I would even consider going up to 12 months of living expenses saved up, and that's gonna be on the very conservative side. Ideally, that's being saved in a high-yield savings account, earning you some interest. If you don't have one yet, I will link some down below as well. But the general personal finance rule of thumb here is that you have 3 to 6 months of your living expenses saved up in an emergency fund, and if you already have that and you're good with that, then great. If you don't have one of those just yet and you're in your 30s, psychologically, it actually is a lot easier if you break down your emergency fund goal into smaller bite-sized pieces. So for example, instead of trying to save $10,000 or $20,000 in an emergency fund, maybe just try to save $1,000 every couple of months or maybe every 3 months. That's gonna be a lot more attainable. The fifth financial goal to accomplish in your 30s is going to have at least 3 times your annual salary saved for retirement by the time you're age 40. According to the Bureau of Labor Statistics, the average annual income of somebody in the United States by the time they're the age of 40 is $62,000. That means by the age of 40, you should have 3 times that saved in a retirement account or just in general savings in order to get you to your retirement goals, and that amount is going to be around $186,000. By doing so and using a retirement calculator like this following one from NerdWallet, we can assume with investments that you should be able to get to a balance of $2.11 million by the time you're the age of 67. Having a considerable amount of money in your investment account by the time you're the age of 40 is going to be really important, because that gives us at least 25 more years of compounding in order to hit our retirement goals. Now, if you haven't reached that point quite yet, it's important to not get discouraged, because while you're in your 30s, you still have at least 2 to 3 decades left for retirement, and that's still a lot of time to compound your wealth. Personally, I think that if you're watching this channel, I would love to know from you down below if you guys are on pace for this goal, you're ahead of this goal, or perhaps you're a little bit behind this goal. If you're younger than the age of 30, then 3 times your annual salary by the time you're age 40 is a good North Star goal to have. Ideally though, if you're part of this community, I want you guys to aim even higher. So go for 4x, 5x, maybe even 6x your annual salary by the time you're age 40. That's gonna make things so much easier for you guys down the road. The 6th financial goal in your 30s is one of my favorites. It's to avoid lifestyle inflation. You're probably making a lot more money in your 30s, and the best way to sabotage that is spending too much of that new money. One of the lessons of the book, The Millionaire Next Door, right here is the fact that most people who are great accumulators of wealth are actually not spending too much of their income. They often try to keep their lifestyles as cheap as possible, and therefore that difference between how much they make and how much they spend allows them to accumulate wealth like no other. On the flip side, many people that look really well off are actually in deep debt. The book goes on to say that physicians and lawyers, while they do earn above average incomes, they tend to spend a lot more money because they want to drive the same cars or live in the same communities as their colleagues do. And these are the same people that struggle to pay off their student debt. They still have high mortgage balances, as well as the fact that they might live paycheck to paycheck even on a large salary. The author found that the millionaires that accumulated their wealth the quickest kept their spending at the same level or just increased it very, very slightly while their incomes rose. My favorite analogy of the book so far is the fact that if you have a growing income, that's known as having a good offense, and if you have a good defense, that means you're not spending as much money. One of his famous quotes in the book is the following, quote, "Great offense and poor defense translate into the underaccumulation of wealth." And quote, "The foundation stone of wealth accumulation is defense, and this defense should be anchored by budgeting and planning." Essentially what he means is that you can have a really strong offense, but if you don't have a good defense, you're not going to be accumulating wealth in the potential that you should be doing. For example, I have a lot of friends that are in really good jobs here in San Francisco, and they make a lot of money, 500K, 800K, even up to $1 million, but they all spend a lot of that income. So at the end of the day, someone who's making 500K a year, if they're spending $450,000 of that income, they're not actually making progress into financial freedom by accumulating that wealth. You could be earning a lot less of an income, yet you're saving a higher absolute number of dollars just because of discipline and budgeting. And so it really goes to show you that even if you don't make as much as, say, a really high earner, it's still able to be done. Obviously, would we rather just want to make a lot more money? Yes. Obviously, that would be the best thing, but we got to work with what we got. The seventh financial goal to achieve in your 30s is to start to develop an estate plan. I know what you're probably thinking, like, dude, Humphrey, I'm 32 years old. Why do I need to prepare for my eventual passing? Well, the key deciding factor here isn't necessarily your age, but rather if you have dependents and also assets to be distributed in case of your eventual demise. If you do have kids, you probably should start to develop an estate plan. The major components of an estate plan are developing a living will, even if it's a basic one, and also the healthcare power of attorney. These are just documents that state your preferences in case something were to happen to you. These aren't as hard to set up as you might think. Even having a basic living will is quite easy to do. You just go online, find a living will template, edit it for your own personal preferences, and then what you can do is you take it to a notary, get it notarized. They even have these at UPS stores, and that will at least make it somewhat more official. Of course, if you do have a complicated situation, you might still actually want to go to a legal professional, but just having some sort of basic paperwork is going to go a long way. Another benefit of an estate plan is that you can designate a legal guardian for your minor children. That way you're ensuring that your children are always taken care of. Personally, I don't have an estate plan yet, but I am still single. If I were to get married and have some kids tomorrow, perhaps I would probably start an estate plan. I think it would be a really good idea at that point. The eighth money milestone to accomplish in your 30s today is to invest in your own health. While this is not a direct monetary milestone, having good health is going to lead to you living a lot longer. That probably means you have more time to make more money, which indirectly makes it a monetary milestone in my opinion. It might also mean that you have less healthcare expenses throughout the rest of your life, so it actually saves you money to invest in your good health. We should aim to have healthy habits such as regular exercise and a balanced diet, so perhaps you stay away from the ice cream and the alcohol every single Friday night, huh? God. We should also be making sure that we're getting the proper sleep that we need as well, because that's very important. Now, it's also in our 30s where our metabolism is going to start to slow down, and I know mine has, and your body isn't just the same as it was in your 20s. For example, in my 20s, I used to be able to just hop straight into a workout with no warm-up whatsoever and not have any worry about getting injured. But these days, I really need to warm up before I work out or do any sort of activity, because if I don't, I might just sprint into something and then all of a sudden my back is blowing up. I feel like I could just really injure myself at any point, and I'm only in my 30s. It's only gonna get worse from here, which is a little bit depressing, yes. However, let's just try to keep an optimistic, positive attitude, shall we? This decade, I've been really prioritizing lower impact workouts such as yoga classes and also long walks, and I think that in conjunction with super healthy habits is going to lead to a much longevitous life. There's a famous saying that says, you don't take your money with you when you pass. And I think the same vibe can be applied to longevity. It doesn't matter if you've made millions or even billions of dollars if you can't even spend it because your body isn't healthy enough to walk. The next financial goal to achieve before the age of 40 is to start a 529 plan for your kids or eventual kids if you're planning on having them. A 529 plan is an investment account that allows you to invest and save for any educational costs that your kids might have. You can even start one before your kids are born, and you just basically set yourself as the beneficiary of the 529 account, and then when your kids are finally out in the world, you can redesignate them as the beneficiaries. When you contribute to a 529 plan, you actually get tax advantages with your state, so that means you can actually get a deduction on your own state income. Plus, when you withdraw, you also are withdrawing tax-free, and all the earnings are going to be tax-free as well in a 529 plan, which makes it a really powerful account. So long as the money in the 529 plan goes towards educational expenses, it's all going to be tax-free, and you're going to pay less in tax up front. And therefore, if you're planning on having kids and you're planning on paying for your child's education, it's a really good account to have. In the event that your child does not use the full balance of the 529 plan, you can actually roll it over to the next sibling. So if you have another kid, you could do that. And if you don't have any other kids, you can actually redesignate the beneficiary to yourself for any lifetime or lifelong education expenses. It's a pretty great account if you care about your kids. Now, if you don't care about your kids, then don't do it. Just don't set one up. All right, let me know what your financial goals are in the comments. Again, thank you to Facet for sponsoring a portion of this video. Check them out if you need financial planning. And also make sure to check out my next video right here. And I will see you guys either in that video or the next. All right, peace.